All right.
So guys, jetzt, da bin ich. Schönen Handelstag wünsche ich euch heute und wir haben einen Gast, der bei uns vor 7 Monaten schon da war. Ich war in Seattle und darf an dieser Stelle Dan Niles begrüßen. Dan, how are you?
I'm doing great, Marcus. Hopefully you're doing well too.
I'm doing well. I miss your porch. I have to admit, last time we saw the Eagles in the backdrop landing. Are you still in Seattle?
I'm still in Seattle for now.
For now. We picked a great day to not only talk technology, but also the inflation numbers that were released this morning. 7 months ago, we spoke about artificial intelligence, about the AI boom. And back then, you already said, well, NVIDIA is not overvalued. It's one of your favorite candidates. And ARM as well. Both stocks are tremendously up. And we have a lot of viewers here this morning that have questions for you. Anybody, and I'm going to say this in German, jeder, der mehr über Dan Niles erfahren will. Dan Niles war Ende der 90er Jahre einer der großen Koryphäen unter den Tech-Analysten hier an der Wall Street und Gründer des Satori Funds. Ihr könnt euch bei ihm auch registrieren unter danniles.com, wenn ihr bei ihm auf dem Laufenden gehalten werden wollen. Basically, Dan, I just told everybody you're a great guy, you know, and you're amazing. And if anybody would like to have additional information, they should register on your site, danniles.com. So let's dive right back in, and I would like to start with the big picture before we pick up questions hier. Das noch am Rande. Fragt so viel ihr wollt. Dieser Stream ist für euch. Fragt für den Tech-Bereich. Wenn einer weiß, was in dem Tech-Universum los ist, ist es Dan. Und ich werde eure Fragen dann dementsprechend auch mit einblenden und hier und da auch ein bisschen übersetzen. So we got, I wouldn't say very hot, but we got a bit hotter inflation numbers than expected. The CPI, the headline, and the core rate compared to last month and compared to year on year, both higher than expected. How surprising is this for you, Dan? Are we going to get higher inflation alongside the higher, I mean, the more aggressive growing economy?
I think you have to link those two as you just did, because it's hard to imagine that with the supply-related issues we have and the lack of investment in terms of growing supply, that inflation doesn't stay a little bit higher than what people think. You throw in the Red Sea issues with terms of transportation. We're going to start to feel that later this year as transport costs go up. And GDP grew 5% in Q3 and it grew 3% in Q4, and both were stronger than people expected. So I think it's hard to kind of say, well, the economy is going to be really strong, but inflation won't stay a little bit higher to go along with it.
Now, we saw the ISM prices paid components in the services segment and the manufacturing segment. You also had a bit of wage inflation in the December data that were hotter than expected. And now we have the CPI data. What do you think? How do you think the Fed will react? Is the March interest rate cut off the table, and is it going to happen in May?
Yeah, it's completely off the table. And Jerome Powell pretty much told you it was off the table when he had his last press conference, and he said, essentially that we don't think we'll have the data we need to cut by March. So he took that off the table. The real question will be, is it going to be May or June? Because the other thing, if you remember, is the press conference before this last one, he said, look, and he answered a question where somebody said, hey, what about cutting rates? Would you have to wait for inflation to get to 2%? And his response was, well, if we waited for inflation to get to 2%, it would be too late to start. We should have already started cutting rates. So I think between that and the fact you have a presidential election in November, and I don't think, as much as he says, look, politics doesn't play any part of this, I don't think he's going to want to be viewed as trying to influence the election by cutting rates right when the election is happening. And so I think that kind of backs you into it's either May or June. My guess is it would, it's a 50-50 shot between the two of them.
Now, when you look at the GDP Now forecast for Q1, we're estimating 4.2% real economic growth, which is quite hot. And, looking at history, I would assume that quite a few viewers don't really know that, the American economy has grown nominal 40% since the low of the COVID pandemic. Now, over 4% economic growth, and you see that banks are less restrictive on passing out loans. Can the Fed really afford lowering rates into an environment that is possibly much hotter than consensus estimates, also considering that consensus was pretty off the last 3 years?
Well, exactly. I think, and they have history on this. If you go back to the 1970s, which was the last time you had inflation at these levels, earlier where they were double digits, the Fed preemptively cut 3 different times, and then inflation took off again. And then finally, Volcker had to take rates almost to 20% to kill inflation, and the Fed really doesn't want to do that. So on the one hand, they're worried about if they wait too long to cut, you end up with an economy in a recession. The flip side of it is they're very, very well aware that if they cut too early and the economy is still strong, that they could have an inflation problem. And the one thing we haven't talked about is if you look at the data, and this is something I've been focused on for years now, which is the fact that the number of job openings out there is about 40% greater than the number of people unemployed. And don't forget, the U.S. economy is driven by the services sector. It's very hard to imagine with that kind of excess jobs that you're going to end up in a recession. And I'm sure the Fed is aware of that. And that also, that discrepancy between job openings and people unemployed is also going to keep wage inflation pretty high. And so it's kind of hard, back to what you said earlier, Marcus, with an economy this strong, you kind of would expect inflation to kind of stay a little bit higher because of that. And given it's a services-led economy, with that kind of jobs relative to people unemployed, you would think that would keep wage inflation high as well. So I think it puts the Fed in kind of the same situation I feel like I'm in, which is you're watching the data as it comes in on a daily, weekly basis and really evaluating as you go. And you may need to change your mind as the data kind of comes in and you see what's happened.
So I keep wondering, if you have a Fed that will eventually lower rates this year, and I guess that's still very much in the running, and you have an economy that's growing faster than expected, what do you think will be more relevant for the stock market? A lower descent of the interest rates or stronger economic growth and potentially stronger earnings growth?
Well, I think it's a combination of the two. And this year is interesting because if you look at last year, or even 2 years ago, arguably, in 2021, if you remember, we entered the year, well, actually, consensus was spectacularly wrong for the past 3 years, right? If you go into 2021, the thought was, well, you can invest in all these innovation companies regardless of what you were paying for them. And then the ARK Innovation Fund underperformed the S&P by 50% in 2021. And if you look at 2022, the thought was, well, the Fed's hiking to battle inflation, but these large cap tech stocks will be fine. And then the Magnificent Seven went down 46% in 2022. Now, if you look at 2023, we all thought there was going to be a recession in the back half of the year. And then you got GDP growth of 5% in Q3 and 3% in Q4, and the Magnificent Seven, after being down 46% in 2022, were up 111% in 2023. So you kind of fast forward to this year, and everybody thinks there's going to be a soft landing. I'm in the camp too, by the way, because of the number of jobs available. But if there is a soft landing, that would argue that the Fed can't cut, which means PEs are probably too high. Because if you look at 70 years of history when CPI is between 2 to 3%, and obviously right now it's higher than that, the PE multiple on the market on a trailing basis is 19 times. Right now it's at 21 times. So you could argue the market's 10% overvalued at the current level. So that would mean overall multiples need to come down. But if the economy stays strong, you're going to figure out, well, which companies are beating and which ones are missing. And you've already seen that last year, and you're seeing it this year as well. And the difference is this year, the stocks are actually responding to it. So last year, Tesla estimates came down. All of last year, the stock doubled. Last year, Apple estimates came down all of last year, and the stock was up 48%. This year, Apple and Tesla estimates continue to come down after they reported their March quarters, and the stocks are both down. Meanwhile, Google and Microsoft, where the estimates edged up a little bit after the March quarter, are both up in that 10% or so range. And meanwhile, Meta and Nvidia, where with Meta the numbers went up a lot, and Amazon the numbers went up, they're both up, significantly. And then Nvidia, obviously, everybody's expecting a massive beat and raise, which I am as well, and that stock is up closer to 40%. So earnings and stock prices are actually linked this year, and I think to your point, multiples will also matter along with those earnings. And you're seeing that in today's sell-off, where some of the higher multiple names or names that don't have earnings, they're getting hit the hardest with the 10-year Treasury yield up 10 basis points.
So you and I, we have been talking quite a bit the last few days. I have to admit, since the late 90s, I was on the trading floor back in those days. I haven't seen stock moves like we've seen lately. It's almost like the market is on speed. Oh my God, ARM up 90% in 48 hours. Nvidia up tremendously, $1.8 trillion in market cap now. I mean, how much sense does this still make? Can you really still justify the valuation of these stocks? And what do these incredible explosions, daily explosions in stock prices tell you looking back to the 90s?
Well, the question is, where are you in the 90s? Are you in the mid-90s? Or are you in the late 90s? And if you just from a timing perspective, if you think about it, ChatGPT, nobody had ever heard of it until November of 2022. So it's just a little bit over a year ago. The second thing is, if you look at valuations, back in the peak in 2000, you had names like Cisco, for example, trading at PE ratios well over 100 times. If you look at Nvidia today, it's trading at a PE ratio in the high 30s. So it's hard to call this a bubble. And by the way, Cisco is down over 30% from its highs in 2000, because that multiple has obviously shrunk from over 100 times to where it is today. And so even though revenues are up 3x where they were in 2000, the stock's nowhere near those levels. And if you look at other names like Ciena, where the revenues are up 5 times as much, stock's down over, I think, 50%. And if you look at an Akamai, where revenues are up 40 times, also that stock's down over 50% from its highs. Multiples do matter. But there's no way you can say that we're at peak multiples for, the epicenter of this AI revolution, which is Nvidia, when you've got a multiple in the high 30s. And to put it in perspective, Apple's got no revenue growth, and it's at a PE multiple in the high 20s. So I think the good news this year is that there's a reason that Apple stock is down 3% this year, and Tesla stock's down over 20% this year, because they both had to cut numbers again. So I think stock picking is going to matter. Last year, even if you got the fundamentals completely wrong and you bought Apple and Tesla and you said, numbers should go up, numbers went down, didn't matter, you still made a lot of money. That's not the game you can play this year, I don't think.
When you look at the tech concentration on Wall Street, we are now back at the heights of the dot-com bubble around 2000. The tech sector now makes up about 1/3 of the total market cap on Wall Street. That, in your opinion, is not a sign that we are already at the height of a bubble that could potentially burst?
Well, again, I think you have to go stock by stock, and so that's how I'm thinking about it. So out of the Magnificent Seven, we're short a couple of those names. We're long Amazon and Meta are two of our favorites coming in, where we think Amazon, the estimates can double over the course from 2022 to 2023 to 2025. And we think with Meta, you're paying a mid 20s PE for a company that's growing revenues in the mid teens. The S&P, you're paying a 21 multiple and revenues are growing about 5%. So I think each one's a little different. And you look at Tesla, you're going, well, I'm paying 60 times for a company that's under a tremendous amount of pressure in terms of increasing competition in the electrical vehicle space, and interest rates have gone up, which means financing the purchase of a car has gone up, etc. So I really do think you have to go one by one through these names and then sort through it. To your point, tech is a much bigger percentage of the economy, but if you think about it relative to 2000, tech is a bigger portion of the global economy. So to some degree, you'd expect the companies that are enabling the internet and now AI, which I'm a big believer that AI is going to be just as big a deal in the future as the internet was. And so I think you have to separate out what time period are we in, back to Bill Gates's quote, where technology can be overhyped in the short term, which you could say the internet was in 2000 in terms of where valuations were, but it's underhyped in the long term, which you look at where we are today relative to 2000, and obviously the internet's a much bigger portion of all of our lives. And I think it's the same with AI, but I think AI is more where the internet was in the mid 90s, where you have several more years of growth before you potentially, I think you definitely will go through a correction. My guess is it probably happens sometime early next year, and we can get into why. But I think you at least have probably another, close to a year or so of AI-related stocks being able to go higher, because the valuations, as we talked about with NVIDIA, are nowhere near where like a Cisco's was back at the peak.
Yet NVIDIA has now a market cap that approaches the market cap of Amazon, over $1.8 trillion yesterday. And if you invested $10,000 in NVIDIA in 2010, those $10,000 now grew into almost $1.8 million. So quite a performance. And the stock is up $650 billion in market cap within 2 months, the equivalent of Tesla. Yet you still think that when earnings come out on the 21st of February, that they're going to beat enough to satisfy investors?
No, they definitely won't. What I mean by that is, with all of these stocks, there's the long term, and then there's how you trade around as short term. So if you think of NVIDIA for the past 2 quarters, the stock ran up into the earnings. And then when they reported, you had a chance to buy the stock, I think 2 quarters ago, down about, well, over the last 2 quarters, you had a chance to buy the stock about 10% cheaper both times. Once it dropped 8%. The other time, I think it was 14%. And so regardless of what they put up, it probably won't be enough to satisfy investors. So the day they report the quarter, I doubt I will own the stock that day, because it is the most known thing on the planet that numbers are going to go up a lot. So even if numbers go up a lot, much like you saw when they reported the prior 2 quarters, in the short term, the stock's likely to, in my opinion, probably pull back. And then you have another chance to buy it, because everybody knows that customers are double and triple ordering and quadruple ordering to get these chips, because you need these chips to make your AI systems work. And they have the best chips on the planet. And so at some point, you're going to have them come out and having to cut numbers. I think that's probably more next year, early next year. And at that point, you're going to figure out how the stock reacts to it. But I think between now and then, there's more demand than they can possibly supply. And so the day of earnings, will we own it? Probably not. Will we likely to buy it back after it declines and people say, oh, the fall off is just around the corner? Probably, because the multiple's low enough where it justifies for me wanting to own it, because I do think estimates are going to go up a lot again.
I love it, because last 7 months ago, when we sat together in Seattle, we had the same debate. People were saying this is insanely overvalued. This, this can't go any higher. And it kept marching, and you kept saying 7 months ago, no, this is a great stock to own. This is one of your favorite stocks, and it really panned out. And by the way, Stanley Druckenmiller, hedge fund manager as well, he said the same thing you're saying, that, well, yeah, I mean, they might run down eventually, and it would be a great opportunity to go back in, because this is probably not the end of the rally. I want to touch on one base, which we spoke about privately a couple of days ago. We have elections coming up. There's a good shot that Trump might actually be once again president of the United States. How is this actually affecting the demand out of China in AI, but also in the chip industry? And is this basically pulling demand forward in the market?
Yeah, absolutely. No question. I mean, that's the one thing I hadn't, when Trump came out and said he was thinking about 60% tariffs or higher on Chinese goods to get the trade deficit, basically back to zero. You look at that, and between that and trying to cut off technology, don't forget, Trump was the one who started finally saying, look, we need to protect our intellectual property. And he was the one who started cutting off chip supply to China. And, the current administration has continued those policies. So if you're the Chinese, you're looking at this going, oh my God, if he gets back into office, we need to make sure we buy everything we can. And you can see that whether you're talking about, AI chips, where the demand is tremendous coming out of China. But look more broadly, if you look at semiconductor equipment, the stuff you need to make these chips, for some of the biggest companies in the world, China is 40% of revenues. So it's going on. So I think what's going to happen is, whether it's President Biden gets reelected or President Trump gets reelected, the Chinese can't afford to take that chance. So they're going to buy as much stuff as they can in front of this. And so you're having demand pulled forward by multiple years, arguably right now. And then when the elections happen, if President Trump gets elected, well, we know what happens then. But even if President Biden gets elected, China will have bought forward so much stuff that you're going to hit an air pocket, I think, sometime at the beginning of 2025 at this point. Still adjusting to not being in 2023 anymore. Being in 2025 or at the end of 2024, because the elections are obviously in early November. So for me, that's when I go, I have to make sure I've sold everything that I love today, and I'm probably short most of what I love today, because the demand will have been pulled forward so much, specifically in areas like semiconductors, that's where I'm going to have to be incredibly negative. And don't forget, we love NVIDIA today, but if you go back a couple of years ago, NVIDIA's revenues went down 30% in 6 months because the hyperscalers, meaning Google, Amazon, Microsoft, et cetera, had bought so much stuff for their data centers. They bought in advance because, don't forget, during COVID, you couldn't get those chips. They bought in advance, then they had to digest it. The revenues went down a lot. NVIDIA was pre-announcing negatively, and the stock was getting hit. Then ChatGPT shows up in November of 2022, and everything then takes a leg up, because now all of a sudden their chips are going into AI. And NVIDIA is the enabler of the AI revolution. Don't make any mistake about that. You need this to make it happen. But it doesn't mean that, much like you saw with hyperscaler demand having an issue in middle of 2022, that you're not going to have an issue with AI demand sometime in 2025. And I think I'm convinced that will happen.
But all of that basically means that the growth path for 2024 is going to be aggressive.
And, it's going to be higher than anybody anticipated, because of exactly what you brought up, Marcus, which is China is going to just buy as much stuff as they can get their hands on between now and the beginning of November when the presidential elections happen.
I'm going to show the first question here, and I'll translate it for you in a second. Essentially, it feeds into the idea, Donald Trump is talking about potentially thinking about 60% tariffs for Chinese imports. I mean, he thinks about a lot of things. If this will actually happen, is a whole different ball game. But him just loudly thinking about that must create a certain sense of panic in China in regards to pulling demand forward, right?
Absolutely. And by the way, that was already occurring before that, because don't forget, President Biden's been cutting off the highest NVIDIA chips to China already. They've been cutting off the highest manufacturing equipment from ASML already. So China has already been trying to get as much stuff as they can to work around the sanctions, whatever you want to call them, to get this, because for them, I think, they view the semiconductor industry as important as having an aircraft carrier, right? It's defense spending, because you can't have the U.S. cut off chips and have that destroy your economy in your high-tech industry. And so for them, spending on cap equipment is the same thing as spending on an aircraft carrier.
So we have another question here regarding demand from China being pulled forward. I think we answered this question already. So, let me continue with individual stocks. And let me touch on ARM Holdings. Back in the day before the IPO, you said that's going to be Europe's answers to NVIDIA, and the stock has been up tremendously. Now, when you see a stock going up, of that size by 90% within 48 hours, I mean, can you still make sense of that? Is that justified looking at the numbers?
Well, here's the thing, and to be fair, we sold yesterday at the close because I couldn't. To your question, because here's the difference between that stock and NVIDIA. NVIDIA, as I said, is trading at 38 times or so earnings. ARM's trading well over 100, and rightly or wrongly, at my core, I'm a growth at a reasonable price investor. And so for me, I would rather own NVIDIA at current levels versus an ARM. But it doesn't mean, because of a bunch of different things, that ARM stock can't double between now and year end. It just, given the move over 4 days or 3 days, as you mentioned earlier, Marcus, to me, it was just impossible to sort of stay with that.
It's also a great sign.
For the viewers that don't.
It's also a great sign you just can't short this kind of stock, right? Because you get your face ripped off if you're wrong, right?
Well, absolutely. I mean, and for me, ARM is their designs are in Google's chips. They're in Microsoft's Cobalt chips. They're in Amazon's Gravitron chips. They're in NVIDIA's Hopper chips. So they're enabling all of the chips that are powering the internet. Don't forget, NVIDIA tried to buy ARM, and it got blocked, which tells you how important NVIDIA thought ARM was to their ambitions going forward. So ARM is a fantastic company. But as I always like to say, don't confuse a stock with a company, because those are two very different things. Cisco's been a great company for the last 25 years. It's just been a horrible stock. Ciena's been a great company. Akamai's been a great company. It's just, if you bought them at the peak in 2000, you're still down tremendously given the price you paid for them. And so I think, a lot of investors, they go, it's a great company, don't care about the price. ARK Investments is a good example of that. And you've seen what's happened. You have to always care about the multiple that you pay, especially when you're in an environment of easy money. It distorts prices for everything.
You were part of the earnings call from ARM. I would like to touch on that. What was your take on the earnings call? Also, when you look at the importance of the Chinese market for ARM, and on March 12th, the lockup period ends. You only have about 9 or 10% of the stocks in the free float. 91% is still owned by SoftBank. Is there a risk that the end of the lockup period, we're going to see quite a bit of profit taking?
Well, I think what you're going to see is in the lead up to the lockup release, there's going to be a lot of profit taking because people know, I mean, stocks are real easy, right? The price goes up if there's more demand than supply. That's it. So what do you know is going to happen on that date? You know there's going to be a lot more supply. So I think people will try to get in front of that. And if you, I mean, everybody's made huge profits on this name, right? Unless you bought at the peak yesterday. So I think you're going to see a lot of profit taking between now and then because people know that lockup release is coming. And quite honestly, from my perspective, that's when I might look to buy, you know, we'll see what I end up doing, right? Depends on what the stock does, right? If it's down 30% or something in the next week, then that may change this. But bottom line is that's when I would look when the supply hits the market and the stock finds its new level given the increased supply because the lockup period releases. That's when, to me, it's safer to say, okay, you know, now I can go ahead and buy the stock again because they are in all these enabling chips for the internet. But don't forget, their main market today is still smartphones. And so that's where they have the dominant share. That's what's driving their business. And to what you brought up, Marcus, again on the China situation for ARM, you know, one of the questions asked on the call is, well, if you back out China, the rest of your business actually kind of didn't do much or shrunk. And that again goes back to how important China is for all of these chip companies. And so again, I think ARM has an expiration date sometime early next year where you're going to have to reevaluate when, you know, China probably that pull-in starts to work its way through and they have to digest that.
I think that's, to me, one of the most important takeaways that, yes, you're pulling demand forward. You will have tremendous growth, but then next year, early next year, you might want to be a bit careful. I want to dive into a few stocks before we let you go. I know your time is precious and limited. So we usually talk about the Magnificent Seven. This year, the Magnificent Seven are more like the Magnificent 3 or 4, with Eli Lilly now also being pretty much one of the Magnificent 7. But we do see quite a bit of changes. And I remember sitting down with you 7 months ago, you were not a huge fan of Apple. And Apple is struggling a bit this year. What's your take on the stock?
Well, here's the bottom line. So ignore what the stock has done and look at the earnings. When they reported the March quarter last year, the forward numbers got cut. When they reported the June quarter last year, the forward numbers got cut. When they reported the September quarter last year, the forward numbers got cut. And when they just reported December, the forward numbers got cut. You've had 4 quarters in a row where the forward numbers for revenues got cut. And if you look at what they guided to for the March quarter coming up, it's the same as the revenues 3 years ago. Now, it didn't matter for the stock last year. The stock was up 48%. Now, it was up the least of the Magnificent Seven, but who wouldn't love to have a 48% return in a year, right?
Yes.
So even if you got the fundamentals completely wrong, you made a ton of money. Tesla is even a bigger case where estimates went down 50% last year, and the stock doubled. So this goes back to the discussion we had earlier where Apple, what people want to believe, what the bulls want to believe, and so they just keep saying, oh, you know, services, and they have this big installed base, etc. Okay, well, that's great, but you could say the same thing for AT&T and Verizon, and they're not trading at nearly a 30 PE. They have a big customer base. Nobody's going to give up their cell phone either, but there's no growth there. You're paying them for a dividend stock, and the multiple's quite a bit lower. And you look at Apple, it's a similar situation, but Apple's got a much bigger problem. There's no new competitors for an AT&T and a Verizon. For Apple, back when Donald Trump was president, he cut off chips to Huawei. And so now, for the first time, Huawei has a flagship phone for the first time since 2019. They were the second biggest smartphone manufacturer in the world back in late 2019 with about 16% market share. That market share dropped to the low single digits. Now it's ramping back up again. And they're taking a tremendous amount of share back in China and from Apple at the high end. In addition to that, you've also got Apple doesn't have any AI on their phones. Samsung's already, and you may have, if you watched the Super Bowl, you saw the Google ad where it shows, somebody circling the screen and it can tell you what that is. The Samsung phones, a lot of the high-end phones already have AI capabilities built into the phones. And in addition, the foldable phones are really gaining a lot of share now that they've solved a lot of the screen issues from when you fold them. And Apple doesn't have one of those either. And so that's Apple's issue. It isn't the fact that China as a country is slow growth. That's true. The bigger problem is they have rising competition in China from Huawei on the one hand, and then the foldable category and AI on smartphones on the other hand, with guys like Samsung. That's what's causing the issue at Apple. And that wouldn't matter if you had a PE multiple that was below the market. But the PE multiple is at 28 times, and the S&P is at 21 times, and you're not getting any growth. So that's why, for me, I don't like Apple, because at some point, stock prices do match up with earnings potential going forward. And for right now, the bull case is, well, the stock did great, so I'm going to ignore all this and focus on the stock price. But when the stock price doesn't do well, then people, funnily enough, look at fundamentals. And that's kind of how it's worked for the last several years, is the stock price seems to determine the fundamentals, not the other way around. And with the stock now not acting well, I think people are starting to focus a little bit on the fundamentals for the company.
So the irony is, in a way, that the limitations on U.S. tech exports to China motivates China and Chinese companies to innovate more, to invest more, to become more competitive. Would you actually touch Chinese stocks? I mean, looking at valuation, the China tech sector, it seems like there's only one direction. And looking at valuation, I mean, they're at this point, I guess, valuation of the utility sector is probably almost on the same level.
Yeah, I mean, here's the thing. I thought China stocks would do well this year. And I listed out all the reasons why. The one thing I hadn't thought about, which nobody thought about, was Donald Trump putting 60% tariffs on Chinese goods. So that's a very new development. And so it's something I'm trying to think through right now, because to your point, Marcus, valuations are ridiculously cheap. Alibaba at one point, over half their market cap at its lows was sitting in cash. It had a single-digit PE, and it had enough cash flow, I think, that you could buy back the entire company in 4 or 5 years. Yeah. So that's how cheap things got. But it doesn't mean things can't get cheaper. But right now, I do have actually a long position in a basket of Chinese internet names, which today, at least, is holding up better than the U.S. internet names. But I think, I sort of have this rule of don't fight the hard battles. And if you're staring down the barrel at potentially 60% tariffs, you need to have that in the back of your mind.
So the political risks remain. Dan, we're already well into the stream. Do you still have a few minutes time, or do you need to run?
Sure. For you, Marcus, I have a few minutes time.
Thank you. Let me dive quickly into the stocks that you favor. Amazon is one of your big favors, has been for quite a while. Meta, you really nailed. And you nailed it, I think, right at the bottom when Jim Cramer basically
I got
said,
it right at the bottom.
I will never forget, Jim Cramer's famous video is like, oh, you need to sell it at 98. And you've been buying it ever since, and it had worked out quite well. So looking at Meta and Amazon, you already touched on the potential in regards to margins, and margins increase in operating income is quite tremendous. But maybe you can give us a few words about both stocks, Meta and Amazon.
Sure. I think with Amazon, now I'll run through all the Magnificent Seven just in case for your viewers, and I'll do it quickly. But Amazon I touched on, but the big thing there was they built a lot of capacity during COVID. Then when we all got unlocked from COVID, e-commerce demand fell tremendously, so they had a lot of excess costs from those massive distribution centers. Now, with e-commerce demand picking up again, and AWS, which is Amazon Web Services, which is AI related, starting to reaccelerate, their margins are coming in well above what people thought. They beat the September quarter operating profits by 40%. They beat the December quarter by 20%. And so, as I said earlier, I think EPS has the potential to double GAAP EPS by 2025 relative to 2023. With Meta, they're really using AI the best, you could argue, of all the big companies in terms of using it. So they're using AI to help recommend what videos you'd like to watch. They'll probably recommend yours, Marcus. And also how to monetize those ads. And it's, as I said earlier, it's trading at a mid-20s PE for 15% or triple the S&P 500 market growth. Google's a trickier one in that Google, if you look at last quarter, they missed their advertising revenues. They missed in YouTube, they missed in search, they missed in owned and operated. And so I worry that ChatGPT, because it's growing so fast, is taking some market share away from Google in terms of search revenues. And then I'm also concerned that things like the ad-supported tiers at Netflix and Disney, and now Amazon Prime is showing videos, that's going to affect YouTube going forward for Google. Now, the one thing they do have, obviously, is their AI business, Google Cloud, did better than expected this last quarter. And the multiple is not that, it's not egregious at all. So that's one where I have more mixed feelings. And the numbers didn't change very much after they reported. We talked about Tesla. I think we talked about Apple. We talked about NVIDIA. Microsoft is the one we didn't talk about.
Dan, I'll touch on Microsoft in 1 second, but I just want to throw in here, I think people have to realize how strong the Meta earnings really were, because you still have a tremendous loss in Reality Labs. You had a lot of extraordinary expenses. And despite these two factors, they were still able to beat tremendously. And one thing you touched on already 7 months ago, Meta has the possibility to reduce operating costs and increase profits, right? So that game has not been entirely played out either yet, right?
No, it hasn't. And as you brought up like kind of a secret weapon or insurance policy, which is because Meta is losing so much in Reality Labs. If they ever have a problem with the rest of the business, much like in late 2022 when they said we're going to spend tens of billions on the metaverse, and the stock got crushed and it went to the low 90s. And I remember I was on CNBC saying, look, they can change their mind anytime they want. And Zuckerberg's not stupid. And 2 weeks later, he came back and he said, we're not going to spend as much money. The stock took off. It's the same thing with the Reality Labs right now, where that gives them an insurance policy, which these other companies really don't have as much of. The other thing, which could give it some real sex appeal and get the multiple up a lot, which we didn't touch on, is the Meta Ray-Ban glasses. And those are kind of interesting because on one end of the spectrum, you have Apple with this $3,500 ski goggles that they're trying to sell to people, which
I can tell you're really excited. Let me guess, you bought a pair, no?
Yeah, I can't see people wandering around the street wearing those. The flip side of it is the Meta Ray-Ban glasses. They look like any other glasses. It's very hard to tell if they're different, and so by the time they get the new version at the end of the year, does that become the way we start to use AI in a big way? Using those glasses. And, the market's really not giving the multiple much credit for that, and that's understandable. It doesn't even move the needle, just like it doesn't move the needle for Apple either. But it's something I do wonder about and go, at $350 versus $3,500 for Apple's Vision Pro, that could be something that we're talking about late this year as, hey, this is pretty interesting device, because we've had a lot of versions of this, right? You've had, Google Glass, and I think was it Snapchat Spectacles, or I forget the name of it, but you've had different companies trying to produce smart goggles or glasses, and nothing's worked so far. And I do wonder if maybe Meta has gotten it right. And if you think about it, there were a lot of smartphones before the iPhone came out. There were a lot of music players before the iPod came out. And so a lot of times it takes a few iterations before you get the product that everybody goes, oh,
Yeah.
this is something that I actually wouldn't mind wearing or using.
There's a question regarding AMD. The market is playing AMD, of course, as a huge AI winner. What's your take on that?
The way I look at it is AMD, people are buying those chips. I don't believe they're as good as what NVIDIA has, but you can't get the NVIDIA chips. So, AMD is a good thing to have. The other thing is NVIDIA is charging exorbitant amounts of money for their chips. And so to some degree, if you say, well, we're using AMD, it helps keep NVIDIA a little bit honest. In some ways, it's like the old days when people would buy AMD chips just to keep Intel honest. And so I think that's going on right now. Don't get me wrong, the AMD has very good chips. It's just not as good as NVIDIA's, in my opinion, and from what I've heard from talking to people that buy both chips. But they are incredibly good chips. They are going to ramp up. But the problem is on GAAP earnings, AMD looks expensive relative to NVIDIA. These are all going to trade, in my opinion, as a group. But the one thing to remember, forget about the stock prices for a second, which I know is hard to do. AMD, when they reported the most recent quarter, the estimates went down for March. They didn't go up, they went down. Mm-hmm. They guided below the street for revenues. NVIDIA has been absolutely crushing estimates for multiple quarters. And if you look at today, Arista's numbers didn't have the upside that people thought. That stock's getting hit. Teradata, another name that was supposed to benefit from storage, needed to store all that information to feed your AI models. Numbers went down. Stock's getting absolutely destroyed this morning. So if you think about all the companies that are AI related in chips, what other company other than NVIDIA can you think of where the total revenues went up? I struggle to find one because yes, the AI portion for all of these companies, including AMD, the numbers are going up, but the spending on other parts of their business is going down as an offset. And that's the key. And I think, when you want stocks to go up and you own them, like you want to focus on, oh, yeah, I'm going to focus on this and I'm going to ignore everything else that's bad, because if I focus on that, then I have a problem justifying what I'm paying. That's something I try not to do. And in the short term, it really doesn't matter. Like we mentioned with Apple and Tesla last year, it didn't matter what earnings did. The stocks went up a lot. But you go through these periods of times then when earnings do actually matter. And I think you're starting to see that this year with how the stocks in the Magnificent Seven have dispersed between the ones that are really crushing numbers like an NVIDIA, a Meta, and then moving to the next, and an Amazon, and then moving to the next year with Google and Microsoft kind of in the middle where numbers are just edging up maybe a little bit. And then you move to the last group, which is Apple and Tesla, where numbers are going down and the stocks have come down.
Last question before I dig out one or two more audience questions. Microsoft. While we're doing this interview today, the Wall Street Journal is reporting that, the Copilot might not live up to its hype. And you yourself say, technology is often overhyped in the short term and long term underestimated. Are we reaching a point where also Microsoft, the hype in the stock, and the stock is not the company, I think that's a great quote, but is there a risk that estimates are becoming too euphoric, even for a company like Microsoft?
Yeah, I think there really is that potential. The PE is not low either. It's trading at about 35 times, 34 times PE. So it's not exactly cheap. But having said that, Windows 10 is going end of life in 2025. I think you are gonna have PCs that are enabled with AI. But yeah, I do. Azure is growing 28% year over year, which is very strong. But it grew 28%, I believe, last quarter as well, if I remember correctly. So it's not like it's accelerating. The growth's already high, and so Microsoft is also kind of in that in-between category. And you saw that with the numbers again, right? The numbers really didn't change for Microsoft after they reported the March quarter, and that's why the stock is sort of in between in terms of performance as well, where it's up high single digits for the year, which is still better than the market, but that's why it's where it's at.
So if I get you correctly in our interview, it sounds like the chance, so you wouldn't own NVIDIA into the earnings?
Yeah, but between now and earnings, I'll own it.
Okay, the earnings are
Well, that depending on how the market trades,
yeah.
we'll figure it out. But yeah, but I think the right thing with NVIDIA has been to own it till the day they report, but not be there the day of for the last two earnings releases. And obviously, we'll get a lot of data between now and then. Obviously, if the stock's down, 20% because the entire market sells off, it's a different situation. But that's typically been the way you wanted to view it. But and today's actually hanging in pretty well, given what the tape's doing.
But your message seemed to be, as is on ARM, that even if you get phases of corrections, even maybe bigger corrections, by the end of the day will be the opportunity to load up on these stocks for the remainder of the year. One last question from the audience. Do you have any favorites when it comes to AI? Favorite stocks?
I think we talked about them.
Or companies?
To some degree, right?
Yeah. Not without diving deeply into them, since we already touched them, but if you would look at the AI companies where you're like, okay, these are my favorites.
Yeah, I mean, I think it's the two of my top picks were Amazon, right? They have AWS. The other one was Meta, because they're using AI effectively for ad monetization and recommending videos. And then obviously NVIDIA is one where they're supplying the chips that make this all possible. So I think if you were going to pick three names, those would be sort of the three I would pick. Mm-hmm. And don't forget, I run a hedge fund, so we have shorts that we match up against it. And as I said earlier, we're long some of these names. We're short some of the other Magnificent Seven names. You can probably guess which ones. And that's how we're trying to make money. And that's how we did well, even in 2022. When these tech stocks just got absolutely obliterated, is I think you had to kind of pick stocks relatively. Yeah. And that's what we're trying to do this year. And I think this year it'll be very important as we go through the year to pick the right names and focus on earnings.
I think most people probably already forgot, but 2022, the big caps were down 46% on average, and you were up that year with your hedge fund, which was great work. One last question, and then we're going to wrap it. What is your opinion on also the dramatic rise of Supermicro?
If you don't mind, I won't comment on that one. Okay. But I think in talking about. For me, the way I think about it is, as a whole, personal computer manufacturers, all they're doing is they're assembling chips and operating systems and putting those together. So the value that they're adding, and you can see that in their gross margins, where you've got an NVIDIA sitting at 70% gross margins, but then you've got PC vendors sitting in the 20% or so gross margin range. There's a big difference, and you can see it in gross margins, operating margins, and net income margins in terms of the value that they're adding. And so sometimes it comes down to who can get chips, who can't, and then who is solely focused on one particular sector, and so the sectors that are doing poorly are not impacting them. And so that's what I would say when I'm thinking about the world as a whole.
Great. Dan, I really appreciate you taking this much time for us. We wanted to stream for about 20 minutes. That now has gone almost to an hour.
Oh, my God.
Thank you very much. And you have very good dogs. No barking in the background, even though we love dogs. So best regards to California, to your family as well, and your kids. And hope to see you soon. Thank you very much.
Well, survive the snow in where you live, Marcus, and best to you and yours.
I'm going to go shoveling now. Have a good one. Bye, Dan.